Mutual funds. What are the advantages and disadvantages of mutual funds? 8 advantages of mutual funds. First one, diversification. One of the primary goals of investment must be diversification of risk, and mutual funds accomplish this goal well. With a single mutual fund, you invest into various assets and many corporations. If one stock or asset goes down, there are others that may compensate for it. Second, professional management. Mutual fund managers are highly qualified and experienced professionals who are constantly researching, analyzing, and managing their funds. Mutual fund companies have access to information beyond what you as an investor, individual or retail investor have. Third, liquidity. You can sell or buy mutual funds anytime. Mutual funds are good if you want to invest in an easy to liquidate instrument. Investments can be redeemed within 1 to 3 working days. Next, convenience. Mutual fund investments are highly convenient as you can invest through various channels like Demat account, online bank investment account, direct through mutual fund houses, mutual fund distributors, various online investment platforms, etc. Can invest anytime, can invest in very small amounts, and can easily track your portfolio through mobile apps or monthly reports. Get professional management without amateur intervention, access of investment in few financial securities such as government securities, which you as an individual or retail investor do not have easy direct access to. Next, reinvestment of income. Mutual funds allow investors to reinvest their dividends and interest in additional fund units. This helps in timely investment of your dividends and interest, giving a compounding effect. Next, range of investment options and objectives. You can find a mutual fund that matches almost exactly what you are looking for from an investment point of view. This could be related to both your risk profile and your investment horizon. Next, affordability. You can start your mutual fund investment with low investment. With that units of mutual funds, you could own assets of many corporations, which otherwise is not possible with such small amounts. Next, transparency and ease of comparison. You can track your fund performance on daily basis and easily compare your mutual funds with peers and benchmarks to know their performance and accordingly take a call to invest more or to sell the existing one. 5 disadvantages of mutual funds. First one, exit loads. Many of the mutual funds charge an exit load, which means a penalty if you redeem your investments before a certain time frame. Exit loads varies across fund schemes and can be high as 2 to 3% of the total redemption and can also be 0%. Next, management fees or expense ratio. As the saying goes, there are no free lunches on Wall Street. Same goes for mutual fund. A mutual fund charges a fee for managing your money. If a fund earns 10% return and has a 1.5% expense ratio, it means you would mean that 8.5% return for you as an investor. Next, subject to market risks and no guaranteed returns. Even though different kind of mutual funds carry different risk profiles, but none of them gives you guaranteed returns like bank FDs, PPF, etc. Returns depend on the stock market conditions for equity-based funds and on interest rate fluctuations for debt funds. Next, unethical practices. Mutual funds may not play a fair game. Each scheme may sell some of the holdings to its sister concerns for substantive notional gains and posting NAVs in a formalized manner. Next, selection of proper fund. It may be easier to select the right share rather than the right fund. For stocks, one can base his selection on the parameters of economic, industry, and company analysis. In case of mutual funds, past performance is the only criteria to fall back upon, but past cannot predict the future. What is the difference between close-ended mutual funds and open-ended mutual funds? Close-ended mutual funds versus open-ended mutual funds. First, number of units outstanding. In case of close-ended mutual funds, number of units outstanding is fixed as decided in new fund offer, NFO. In case of open-ended mutual funds, number of units outstanding can issue units regularly based on demand. Next, term. In case of close-ended mutual funds, it is difficult to exist before the end of term of the scheme. In case of open-ended mutual funds, there are no entry-exit terms. Next, units to be sold. In case of close-ended mutual funds, the unit cost and the number of units to be sold are fixed. In case of open-ended mutual funds, there is no such restriction regarding number of units to be sold. Next, timing. In case of closed-ended mutual funds, you can enter only in a small window of time, open during NFO, new fund offer. In case of open-ended mutual funds, you can invest anytime and choose your own investment time. Popularity. Closed-ended mutual funds are less popular and holds about 120% assets of mutual funds, whereas open-ended mutual funds are more popular and holds 88% assets of mutual fund. Next concept, exchange traded funds, ETF. These are a type of investment funds that tracks an index, a commodity, bonds, or basket of assets. The exchange traded funds trading value is based on net asset value of the underlying assets that it represents. Think of it as a mutual fund that you can buy and sell in real time at a price that changes throughout the day. Exchange traded funds typically have higher daily liquidity and lower fees than mutual funds, making them an attractive alternative for individual investors. In some sense, the exchange traded fund is like a stock, as they are traded on the exchange on real-time basis and thus needs a demat account for trade. In another sense, they work like mutual funds, as the underlying asset comprises of the set of stock or assets. Example, Goldman Sachs Gold Exchange Traded Scheme and SBI Sensex ETF Exchange Traded Fund. What are FMPs? Fixed Maturity Plans. Fixed Maturity Plans, FMPs, are closely ended mutual funds in which an investor can invest through during a new fund offer, NFO. FMPs, Fixed Maturity Plans, usually invest in certificates of deposits, that is CDs, commercial papers, CPs, money market instruments, and non-convertible debentures over fixed investment period. Sometimes they also invest in bank fixed deposits. In new fund offers, during the course of which FMPs are issued, are later traded on the stock exchange where they are listed. But the trading in FMPs is very less. So basically, FMPs are not liquid instruments. The main advantage of FMPs is that they are free from any interest rate risk because FMPs invest in debt instruments that have the same maturity as that of the fund. However, they carry credit risk as there is a possibility of default by the debt issuing company. So, if the credit rating of an instrument is downgraded, the returns of the FMP can come down. Presently, most of the FMPs are launched with a tenure of 3 years to take the benefit of indexation. But because of the longer maturity period, they find it difficult to provide good returns in the form of interest to the investors in highest rated instruments. They therefore assign some portions of the invested funds in AA and below rated debt instruments to earn higher interest. The reason is that lower rated instruments carry higher coupon rates than higher rated instruments. Write a short notes on side pocketing. Side pocketing. In simple words, a side pocketing in mutual funds leads to separation of risky assets from other investments and cash holdings. The purpose is to make sure that money invested in a mutual fund, which is linked to stressed assets, gets locked until the fund recovers the money from the company or could avoid distress selling of illiquid securities. The modus operandi is simple. Whenever the rating of a mutual fund decreases, the fund shifts the illiquid assets into a side pocket so that the current shareholders can be benefited from the liquid assets. Consequently, the net asset value, NAV of the fund, will then reflect the actual value of liquid assets. Side pocketing is beneficial for those investors who wish to hold on to the units of the mutual funds for long term. Therefore, the process of side pocketing ensures that liquidity is not the problem, even in the circumstance of frequent allotments and redemptions. Side pocketing is quite common internationally. However, side pocketing has also been restored to bereft the investors of genuine returns. In India, recent fiasco in the infrastructure, leasing and financial services (IL&FS) has led to many discussions on the concept of side pocketing, and IL&FS and its subsidiaries have failed to fulfill its repayments obligations due to several liquidity crises. The mutual funds have given negative returns because they have completely written off their exposure to IL&FS instruments. Write a short notes on tracking error. Tracking error can be defined as the divergence or deviation of the fund's return from the benchmark's return. It is following. The passive fund managers closely follow or track the benchmark index, although they design their investment strategy on the same index, but often it may not exactly replicate the index return. In such situation, there is a possibility of deviation between the returns. The tracking error can be calculated on the basis of corresponding benchmark return vis-a-vis quarterly or monthly average NAVs. Higher the tracking error, higher is the risk profile of the fund. Whether the fund outperform or underperform their benchmark indices clearly indicates that of fund managers and not following the benchmark indices properly. In addition to the same, other reasons for tracking error are as follows: transaction cost, fees charged by AMCs, fund expenses, and cash holding and sampling biasness. Thus, from above, it can be said that to replicate the return to any benchmark index, the tracking error should be near to zero. The tracking error is calculated as follows: square root of summation of d minus d bar divided by n minus 1, where d is the differential return, d bar average differential return, n number of observations. What are direct plans in mutual fund? One may invest in mutual funds with the help of a financial intermediary, that is a mutual fund distributor or agent, in a regular plan, or choose to invest directly, that is without involving or routing the investment through any distributor or agent in a direct plan. Direct funds are those mutual fund schemes that are directly offered by the fund house or AMC to the investors. The names of these funds are prefixed by the word direct. There is no involvement of a third party, distributor or agent. The investors directly deal with the AMC offering the fund. Since there is no involvement of the third party, there are no commissions or brokerage charges involved in these transactions. Hence, the expense ratio of direct plan is comparatively lower than the regular funds. Next, in case of a direct plan, expense ratio is low. In case of a regular plan, expense ratio is high. Next, in case of direct plan, returns are high. In case of a regular plan, returns are low. In case of direct plan, there will not be any investment advice. In case of a regular plan, investment advice will be there. Next, in case of direct plan, market research has to be done by investor only. In case of a regular plan, market research will be done by distributor or agent. Convenience. In case of direct plan, convenience will be less. In case of a regular plan, convenience will be more.